So welcome to Strategy Saturday. I'm Charles Carillo, and in this episode, we're discussing buying rentals in small towns. The good, the bad, and the parts that no one talks about. Whether you're a new investor or already building your portfolio, understanding small town investing is crucial to avoiding costly mistakes and identifying hidden opportunities. So purchasing rental properties in smaller towns can be a lucrative investment, but it has advantages and disadvantages that investors must consider before getting started. Now, before we examine the pros and the cons, I would like to outline a few key factors that every investor should consider and understand before selecting a market. So number one is jobs. So jobs, job growth, and industry diversity are the most crucial metrics to consider when selecting a market. And renters typically have jobs, and employers are consistently relocating to that area. There is diversity in industries and in employers, and this is an excellent sign that you will have a steady pool of tenants for your units. And you don't want to see one employer employing more than 20% of tenants at your subject property. And you also don't want one primary industry to dominate the town. Consider Las Vegas during COVID with a 33.3% unemployment rate. Literally 1 out of 3 people were unemployed, more than twice the national average during COVID of 14.8%. Number 2 is population trends. So over the past 20 years, what has been the trend in population growth? Number 3, what has been the crime trend over the past 20 years? So hopefully it has been inverse to the population trend. So over the last 20 years, you can just easily pull up these maps right on Google. We have a number of different websites. If you want to reach out, we'll put them also in the show notes that we check when we're looking at population trends. But really what you want to see is with your population trends, pull up over the last 20 years, you want to see that slightly upticking over that time. Maybe there'll be some down years and higher years, but it's really going to be a consistent line if you do 20 years ago and today. And then you want to see the inverse of that with crime, where small trickles down. The thing with crime, which you don't really see, just as another side note here, is why 20 years? 20 years is the big thing because it gives you the real picture of what's happening. So in population, you can have something. So if we just chose, let's say, Florida, right? Just during COVID, we're going to see these massive spikes, right, of that happen. Now, if we went over 20 years, we might see in that same market, like in Tampa, let's just say it would be, it's looking good over 20 years, but it might not be really accurate if you're just taking a small sliver of that, right? That's why we do 20 years. The same thing with crime. And crime can be very misleading because if a new administration comes into an area, small government or whatever it might be, a state, and they start locking up a ton of people, okay? So maybe you'll see a decrease in crime from, 2, 3 to 5 years, right? If you just take that sliver of that last 20 years. And you might say, okay, look, it's decreasing. But the thing though is that crime is not just about locking up people, it's about education and healthcare. And you see which communities and governments are investing into education and healthcare when you look at it over a 20-year term, okay? So over that 20-year term, if I see it ticking down, I know that not only is they're working on crime and they're decreasing it, but when the people are coming through the system, they're actually being rehabilitated, right? And this is something that we know that this is, if they've got it working now, it's most likely going to continue. That's why the 20-year trends. But these are just 3 out of our top factors. To learn more in depth about how we choose markets for multifamily properties, you really want to listen to SS2 and SS3. And with these factors in mind, let's continue with the pros and cons of small town investing there. So what are the benefits of purchasing rental properties in small towns? First off, lower purchase prices. Typically, purchase prices are lower in small towns than in larger cities. Less competition. In small towns, there's less competition from other investors when buying properties and less competition for tenants. Now, rental property development is less likely in small towns than in larger cities. And when developers start building properties, landlords in the immediate area compete for tenants as those units are absorbed, which can lead to lower lease renewals and lower rental rates. Another thing is long-term tenants. It's common for tenants in smaller towns to move less frequently, which minimizes turnover costs and is key to making money in multifamily investing, as well as reducing landlord hassles. Possibility of higher cash flow. So lower purchase prices, consistent rental rates, and reduced competition for tenants are ideal for generating higher, consistent cash flow. So what are the possible challenges of buying rentals in small towns? Liquidity. There is a higher likelihood of liquidity issues in smaller markets. This may make it more challenging to finance, refinance, or sell your property, meaning that there's going to be less players there, less investors that you can sell your property to. There's also going to be less lenders that are more likely to lend on those properties. And if there's any kind of pullback, lenders that aren't in that immediate area, like maybe nationwide lenders, they're going to be the first ones to pull out, right? So it really comes down to, as we always talk about, local banks and local credit unions, they're going to be the ones that are probably going to be in there longer, and they're going to be your friend during any type of small town investing. Number two is market risk. If one employer leaves or if an industry dries up, it might cripple the job market in your town, forcing tenants to move to find work, right? It's less likely to gentrify. So identifying properties in gentrification wave is really the key to achieving above average real estate returns, right? So we can buy and hold in areas that are growing a little bit. There's going to be great, solid wealth building assets. If you're looking to kind of move the needle a little bit more, you really have to get a little granular in really identifying properties in this gentrification wave, as you can find properties in areas in neighborhoods that are on the upswing, okay? And this could take longer. This is where some investors might make a mistake is, the wave is coming, they're in the water. However, it might take longer to catch that wave than they expected, right? So it's difficult when you're having investors where you're trying to value add something in 3 to 5 years. It's much easier if you're buying something and you go, I know it's 10 years. I'm going to stay here for 10 years. And these are the neighborhoods where you're driving through and you're going to see properties that are in tough shape or that haven't been touched in decades. You're going to see some with dumpsters outside and crews out there working on them. And then you're going to see some other ones that look like they just went through the whole renovation process. And you can really see what is happening in that area, and knowing that if you buy in that area, there's money that's being put into that area. And when the money is put in from other investors, it's exactly where you want to kind of get yourself into, because this is where the wave has started. And some people might be early, but finding properties that haven't been touched is going to get you in there as well. The problem is really timing what that time frame is going to be. So at that point, it's difficult to time that, just as a little side note there. And you might come back after 10 years if you've never been in a neighborhood and you go, wow, this has really changed. However, if you're the investor there and you've been banking on higher rents, they might be harder to obtain. The other thing too is in this area is it becomes a little trickier of figuring out how much you really want to renovate those units. Are we going to go with granite, or are we going with a really nice laminate? These are the questions that you have to really figure out when you're doing your market analysis, because the market might not be there for granite yet. It might not be there for many years for granite, but this is what we have to do now so that we can rent it, which is going to give us the best return on our investment at this point. And the problem with small towns is that fewer investors are buying and renovating properties, and these areas do not really gentrify as much. So you're buying properties in a tertiary market, a small little town that's maybe 45 minutes outside the main city. There's not going to be as many investors going in there and pumping dollars into those areas to change them. Okay, it's much different if you're kind of in a main city, right? And you have investors from all over that want to come in, and they know that they're going to be able to do the work. They're going to have a large tenant base to choose from. They have a lot of employers there that are pulling people there, and they know that it lowers their risk. It increases your risk when you come in to do large renovations in smaller towns. And if they do, it usually occurs over a longer time horizon. The next is a smaller potential renter base. So with fewer people to rent apartments, your unit's downtime between tenants could be higher, even if they stay longer. So as we talked before, one of the benefits is that they're going to stay there longer in the properties. However, you also have to know that, yes, they might, normal tenant might stay 2 years, right? In a normal market, let's just say, in this market, they might stay for 4 years, right? But then you think the time between it, hey, usually in a normal market, I can do it. There's 2-3 months of downtime. This might be 6 months of downtime, right? So you have to also pencil this in, that when it's rented, it's great. But when it's not, it's going to take longer downtime. You're going to be paying people probably more to rent those units, right, than you would have in a larger city where they have a consistent, inflow of potential tenants. Now, this episode is not meant to dissuade investors from buying properties in small towns, but rather serves as a guide to obstacles to be aware of when locating markets, choosing towns, and ultimately purchasing rental properties. So I hope you enjoyed. Please remember, rate, review, subscribe, submit comments and potential show topics at globalinvestorspodcast.com. If you're interested in actively investing in real estate, please check out our courses and mentoring programs at syndicationsuperstars.com. That is syndicationsuperstars.com. Look forward to 2 more episodes next week. See you then.
You always want to invest in real estate, but didn't have the time, Didn't know where to find the deals? Couldn't get the funding? And didn't want tenants calling you? Since 2006, I've been buying income-producing properties in great locations that provide us with consistent passive income while we wait for appreciation in the future and take advantage of tax laws while we're waiting. And unlike your financial advisor, we invest alongside our investors in every property we purchase. Check out investwithharborside.com. If you like the idea of investing in real estate, if you like the idea of passive income, partner with us at investwithharborside.com. That's investwithharborside.com.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.